Welcome to Optera's brief introduction to building a Scope 3 emissions inventory. In greenhouse gas accounting, there are three emissions scopes. Scope 3 emissions originate from assets that your company does not own or operate, but are emitted from other entities in your value chain. A company's value chain can be very complex, so Scope 3 is broken down into 15 different categories. These 15 categories can then be grouped based on whether they are upstream or downstream in your company's operations. Upstream categories include the goods and services your company purchases, transportation of those goods, and also things like employee commuting and business travel. Downstream categories include what happens with your products after you sell them, and also your company's leased assets, franchises, and investments. The main sources of a company's emissions in terms of scope and category vary broadly depending on the industry. For example, for companies in the food, beverage, and tobacco industry, the largest Scope 3 emissions by category, by far, is purchased goods and services, which account for 2/3 of total emissions. And these numbers come from CDP reporting. In contrast, for companies in the metals and mining sector, purchased goods and services account for about 1/3 of total emissions, while 40% come from processing of sold products. And just to show one more example, companies in the paper and forestry sector have proportionally larger Scope 1 emissions. Purchased goods and services, while still the largest Scope 3 category, only account for about 20% of total emissions. So, let's take a moment to discuss some of the most prevalent Scope 3 categories, starting with Scope 3 Category 1, Purchased Goods and Services. This includes all the upstream emissions associated with the goods and services your company purchases or acquires. And this includes everything from raw materials to software licenses for tools like Zoom. Upstream emissions are also known as cradle-to-gate emissions, meaning that they include emissions that happen from the time a product's components are made to when it is sold to your organization. There are multiple methods for calculating these emissions, and some are more specific than others. Some methods are based on the amount of money you spend with a specific supplier. Some use product-level industry averages from scientific studies, and some use primary supplier-specific data to help improve accuracy. You might also choose to do some combination of these methods, in other words, a hybrid model. Let's turn to Scope 3 Category 7, Employee Commuting. This includes the emissions associated with the commutes of your employees, how they get from their homes to workplaces. Employees of the same company might use a variety of methods to commute, like walking, taking rail, driving, biking, or other ways. To calculate emissions from commutes, there are a few options. These include the fuel-based method, distance-based method, and spend-based method, with the distance method being the most common. And it's important to note that Category 7 technically can include emissions associated with teleworking for remote employees. Finally, let's talk about Scope 3 Category 11, Use of Sold Products. This includes emissions created by goods and services that you sell to customers. For example, data centers, computer hardware, and web-based software all consume electricity. The generation of that electricity produces emissions. Any product you sell that consumes energy while being used contributes to your Scope 3 Category 11 emissions. Now that we've reviewed what Scope 3 emissions are and some of the categories within Scope 3, let's dive into how you find and gather data on your Scope 3 emissions. Many organizations have all the data needed to calculate Scope 3 emissions. However, accessing that information can often be a bit challenging. Internal teams may not understand why they should provide the data, and internal systems may not have the correct reports built to export the data, and/or the data may live in many different locations. There are several different internal teams that you'll need to work with to access your Scope 3 emissions data. Those teams include procurement and logistics, accounting and finance, sales, engineering, and facilities. Take a look at what Scope 3 data can best be gathered from each team, and feel free to pause the video as you read. So remember, in greenhouse gas accounting, there are three emission scopes. Scope 3 emissions originate from assets that your company does not own or operate, but are either upstream or downstream in your value chain. Scope 3 emissions often make up the vast majority of an organization's carbon footprint. The 15 Scope 3 categories can be grouped based on whether they are upstream or downstream in your company's operations. The main sources of a company's emissions, in terms of scope and category, vary broadly depending on the industry. Most companies already have the necessary data to inventory Scope 3 emissions, although it is likely distributed across different internal teams. Typically, this information will be held by procurement and logistics, accounting and finance, sales, engineering, and facilities functions. Thanks for watching.